Hey accounting students, this video is for chapter number 2. We'll probably have 3 different parts, 3 different videos for this chapter. The topic is to record business transactions, business events. But if you remember back in chapter number 1, we've already done that using this accounting equation table where we have asset accounts here on the left side, 4 different asset accounts in this example, and liability accounts on the right side of the equal sign. Just one type here, although there could be many types of liabilities, plus the equity type accounts. Now, the true equity accounts, at least for a corporation, is this common stock and dividends. If your business were a limited liability company or a partnership or a sole proprietorship, you would have assets and liabilities and revenue and expenses, but the other types of entities would have different account names over here. And that's the main difference between most of these different entities. But we're focusing on corporations for our semester, so we'll see these two. In fact, a little bit more detail here in our last chapter of the semester, chapter 11. But again, we're going to be recording these transactions in a more formal procedure beginning here in chapter number 2. Okay, so here's the procedure typically we go through when we record transactions. We first have to identify whether something is a business transaction, and we need proof that it happened. That's called source documents. And we're going to analyze those transactions, those documents, and determine which accounts are going to change. Again, in our previous example, which one of these columns are going to change. And the only thing you do with an account is either increase them plus or decrease them minus. That's why I like accounting. The math is so simple. It's not even math, it's arithmetic, right? Add or subtract, something you learned in kindergarten or first grade. Now you get to apply it here. Okay, so we're going to identify the account and either increase it or decrease it. But instead of using that table format we just saw, we're going to use something called a journal, a general journal. We'll see the steps in recording it in the journal. Then take those journal entries and transfer them. The correct term is called post into not a column, but in a ledger. And you can picture a ledger like a page for one account. And then there's another page for another account. And then we're going to update the leftover on each page or each ledger account. And that's called the ending balance. And take those balances and rewrite them, reformat them on those financial statements we saw back in chapter number 1. So here's some examples of that first step to get those source documents. For example, if we bought something from a supplier or vendor, we're going to get a bill. That bill will help us now determine how to record, how to journalize that transaction in the general journal. Or if we sell something to a customer, we're going to give that customer a sales receipt. But that receipt itself is now a source document we're going to use to record that sale. And now, if our customer or a business, that receipt we give them would be a bill that they would use to record their transaction in their records. Here's one way of spending money in your bank account: writing a check, and that's a source document. Even other types of withdrawals, transfers out of your bank account, that's are also source documents, those paperwork. Placing an order, a purchase order or PO, may not necessarily be a transaction that you should be recording right away because you haven't maybe received the order yet. You haven't paid for the order yet, but you still need to keep track of placing that order, yeah? POs or purchase orders. Here's something maybe you can appreciate as an employee receiving your pay, your take-home pay being direct deposited into your bank account. But if you take the viewpoint of the employer, the business itself, there's more records involved than that. And we'll see maybe some of those records in a future chapter, but those records are now going to be recording our salary or wage transactions. And then when you deal with a bank again, not just deposits, not just withdrawals, but every single charge, every single credit is now recorded here on bank statements, typically monthly. And that's going to help us on our records record transactions. Here's that word again, yeah? We're going to keep track of different ways, different amounts in our business in accounts. We're going to have asset accounts that we own, that have value, that we're going to use up in the future, or liability accounts, amounts we owe other businesses, other people, and equity accounts. Again, in our corporation, that's represented by the common stock and dividend accounts. If you were dealing with a different type of entity, like a limited liability company, you would have what we call capital accounts for each member. Here's the different ways of making money, revenue. Here's the different ways of incurring or using up costs, expenses. Again, 5 types of accounts: assets, liability, equity, revenue, expense. And when you group up all these accounts together, we call that a general ledger. Each page in this general ledger would be one account. That's one way of visualizing a general ledger. Or sometimes they call this the books of the company, the GL, general ledger. Example of accounts again, grouped by type. Asset types, things we own that have value that we're going to use up in the future. Liability types, things we owe other people or other businesses. Plus the equity types. Again, the true equity are these two here. And also types of accounts, revenue types, different ways of making money, earning money. Expenses, different types of expenses, ways of using up money. Again, examples of asset accounts. All businesses should have a cash account, maybe the money in your wallet, the money in your cash register. But the most commonly used type of cash is the money sitting in your bank accounts. And here's the next best thing to cash: the right to receive the cash or money from your customers. We're just waiting now to collect that cash from your customers. And each customer would be one account in this accounts receivable account. Maybe customer ABC owes you money. Well, that would be one accounts receivable account. Maybe another customer, XYZ, also owes you money. That's another accounts receivable account. But you combine them all together in this one big general ledger account. Here's a little bit more formal: money owed to you by somebody because you made them sign a promissory note. And that note probably will say how much is being lent to them, how much interest you're going to charge, when they're going to have to pay you back. Okay? You're going to receive it in the future, just like this receivable here. Prepaid is another type of assets where you had paid for something in advance. You spent the money, but now you're going to use up that amount you paid in the future. The common ones are insurance. You prepay for the whole year, and you're going to use it up over the year. Or let's say you pay your rent. Typically, you pay your rent in advance before the month is over, yeah, or months are over, and you're going to use up it in the future. Things like supplies, equipment, building, land are easy to identify as assets because you can physically see them. Assets that last a long time, long-term assets like land, building, equipment, we'll have a whole chapter on that, in acquiring these assets, using them up, and even selling them, again, in a future chapter. Liability types, again, things we owe other people. The key word is the word payable. Payable. We're going to have to eventually pay this to our creditors. Another key word here, we're going to learn in our chapter 2 is this word unearned. Even though you see the word revenue here, this is not a revenue type of account. The customer had paid you money in advance, but you haven't earned it yet. In fact, you owe them. You owe them a liability. You owe them a service. You owe them a merchandise you haven't delivered yet. And until you provide that service, until you deliver the merchandise, this is going to be a liability you owe them. Unearned is the key word here, just like the word payable, liability type. The word accrued sometimes is a little bit confusing to beginning accounting students. This even can be applied, the word accrued, to assets, something that has to be built up. You're going to be owing more money, but you're not going to receive a bill like over here or over here. You yourself, we're going to see in maybe the next chapter, have to calculate how much you owe and accrue it, build it up to show how much you owe, a liability. Equity types, again, the true equity for a corporation would be common stock and dividend. And really, another type would be revenue and expense types. Yeah? But now notice the minus here and the minus here. If you increase the amount of dividends, if you increase the amount of expenses at the same time because of the minus and minus here, you're decreasing this equity section of the accounting equation. Here's equity again, equal to the true equity accounts here, and then the revenue type and expense type. And again, notice minus expenses, minus dividends. So if dividends increase because of the minus, equity is going down, decreasing. If expenses are increasing, equity is going down. A more formal listing of accounts and their names is called a chart of accounts. And the way we organize this chart is the same way the accounts appear on that balance sheets. Assets are listed first, or the accounting equation. Liabilities are listed second. And then the equity types, including revenue type and expense types, listed last. Here you can see asset cash is always first. And then the next best thing to cash, accounts receivable. And then the assets that take up a longer time to use up, going down the list here. Notice that they are assigned account numbers, and there's gaps here between the numbers. Just in case later on the company wants to insert a new asset, there's enough space here to put them in the correct order, the desired order. Then liability accounts looks like they're in the 200 range. And then equity types, 300, revenue 400, and expense 600. So now it's going to be a little bit easier to enter these accounts into our accounting records. So for example, if you have a transaction, you're going to have a date, which is a number. You're going to have a dollar amount, which is a number. Now you're going to have accounts which have numbers. Everything can be entered just with your numeric keypad when you're entering a transaction. Let's stop here, and when we come back into our second video, we're going to record transactions, not with plus to increase or minus to decrease like we had done here. Yeah, you can see the plus or minuses. Instead, we're going to learn something called debits and credits. What's confusing to most people is that they think credits will always increase an account. That may be true half the time. They think debits is to take away amounts. That may be true only half the time. Okay, we're going to learn the rule when using debits and credits to record business transactions in the next video.